Thanks.
Thank you very much, Henry. That was fantastic. I won't share what I was doing in the 80s. Running sheets, much more interesting. I'd just like to introduce our first speaker. So is Stu Myers. I had the pleasure of being exposed to Stu's work first in the PhD program here in this building, where I struggled through Myers and Maglev and worked my way through, and then kind of had an awe moment at some point when I saw how it all came together. Stu is one of the founders of corporate finance, and he's going to talk about 46 years and counting, real options. So Stu and Judy Lewent will come up and serve as discussant after that. So Stu, you're first.
Great, thank you. Okay, it's up. I'm honored to be here. It's an honor to honor you two, and Fisher and Absentia. And really, it's an honor for me to think back of the intellectual environment that I had here for 50 plus years and how I thrived in it. It wasn't just these colleagues, it was all my colleagues. And the support, the way the intellectual environment supported thinking out of the box and supported thinking about fundamental things, not just what might sell. So I'm going to talk about 46 years of real options because wait a minute. This?
That's a good question. Yeah, that should do it.
Oh, okay.
Green button.
I can't actually see the screen
If you
here.
nod at me, I'll make
What?
sure you're on. If you just nod at me, I'll forward.
Okay, let's see. I want the first slide. Here we go. You recognize that phrase? It's from Keats's poem called On First Opening Chapman's Homer. I could recite the whole thing to you, but I won't. But let me recite the last part of it. Keats didn't think much of Homer, or didn't know much about Homer, until he opened Chapman's translation. And then he said, I felt like some watcher of the skies when a new planet swims into my ken, or like stout Cortez with eagle eyes when he first gazed at the Pacific, and all his men looked at each other in wild surmise, silent on a peak in Darien. And that picture of being the first to see the Pacific Ocean and realize it was there and how big it was, and not knowing what was on the other side, has stuck with me for a long time. I suspect that when you were working on the option pricing methodology, there were some elements or incidents of wild surmise. When something became clear, something became important, and yet you didn't know where it would lead you. In my case, the wild surmise that I remember came 4 years later. That's why it says 46. When I was on sabbatical at London Business School, and was sitting there trying to figure out why growth firms didn't borrow money or didn't borrow much. And so I was scribbling with numerical examples and some simple equations and drawing some pictures. And then finally I realized that everything I was drawing or writing down was really options. Because I was looking at the investments that growth firms were expected to make, and I suddenly realized that they were real options. Not traded options, but they had the same characteristics as traded options, it's just they weren't traded. They were embedded in the world. And once you got that idea, all of a sudden real options are everywhere. Everywhere. And I think many people have had that same experience, that when they got the idea that there were option equivalents embedded in life, not corporate life, economic life, and that you could think about them in the same way as you do with traded options, all of a sudden they were everywhere. 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 Now, I was at that point working on a paper on capital structure, and so I didn't pursue real options much except for the growth opportunities that corporations have, and then trying to figure out what that meant for borrowing policy and so on. And that led to debt overhang and so on and so on. But I did have the good sense to put a label on it, real options with a capital R and a capital O. And I guess one way I could say is I alerted people to the presence of real options. And as soon as I did, work on real options just exploded. Do I have the next? And here's just a quick list. I always like to start with oil exploration leases, because you remember Jim Paddock, Siegel, and Smith, one of the first empirical papers on real options, and showed that you could make much more sense of bids on offshore oil leases if you accounted for the fact that the bidders were not committing to drill, they were acquiring options to drill, depending on oil prices, depending upon, of course, what the geologists found and so on. But it was the option value that they were bidding on, and not just the oil that was in the ground at the moment. And I just started a list, and here's what I had. A lot of people connected with MIT helped with this. Saman Majd is here, right? There he is. He had two or three articles on real options with Bob Pindyke and me, but a lot of others. And now if you go out and Google or start looking at real options, there's hundreds and hundreds of articles of people who have used the idea to try to unpack some economic activity. I should have mentioned Dixit and Pindyke's book too. Is Bob Pindyke here today? No, I don't see him, but they have a couple other dozen real options that they worked out. So I'm not going to talk about this kind of work much. I would like to go back to what I started with, which is the problem of how real options affect financing, because that at least is reasonably new. The reason it's new is that it took Jamie Reed and I, my co-author here, Jamie Reed and I 30 years to figure it out, and it should have taken us 5. But nevertheless, here we are. So 3 questions. First of all, why isn't real options valuation as routine in corporate finance as you might expect? Why isn't real options and discounted cash flow just go together easily? Second, what can you say about the debt capacity of a real option? I've got to be careful and define debt capacity, and I will in a moment. And third, what can we say about the capital structure of a company that holds valuable real options? And again, I'm thinking of a growth company where much of the market cap is attributable to growth options. Okay? Now, let's start with the first question, because I do think it's misunderstood often. Okay? Whoops. It would have been nice if I could see what was going on. What do we have here?
There's the 3 questions. The next one is
Okay, here we go. So let's suppose we have a standard corporate finance problem. For example, a financial manager is trying to decide whether to build a new factory or expand an old one. And nowadays, people will be careful to do a discounted cash flow calculation, look out and forecast the cash flows out to an estimated economic life of the factory, and then they discount everything back and see whether the NPV is positive. Now, when you think about it for a moment, that's nutty because you don't know what the economic life of the factory is. The truth is that the life of the factory depends on how it performs. And if the factory does well, is efficient, the products it's producing are still in demand, it might last 20, 30, 40 years. On the other hand, if the product fails, or the factory doesn't work, or it's inefficient, you could end up shutting it down early. So the correct way to think about it, if you're doing a calculation, is to do the DCF with a very long economic life, and then add the value of a put to abandon it if things go wrong. That's the right way to think about it. And there doesn't seem to be any reason why you couldn't run the numbers and value the put. And yet you don't see corporations doing that. You see corporations will recognize real options, but not do anything about it if doing something about it means actually calculating a value. Now, there's 3 reasons why this happens. The first is math. Real options are not plain vanilla, typically, and unless you're doing just illustrative examples, you can't just plug them into Black Scholes. And the math scares people off. But I think there's a more fundamental reason than that. Corporations don't avoid math when it pays off for them. You think of the oil companies with their supercomputers to try to interpret seismic data, and the math there is orders of magnitude greater than you'd ever need for valuing an ordinary option, yet they don't mind because there's a payoff and they understand exactly what the supercomputers are telling them. Nevertheless, the math is a hurdle. But I think there's more important reasons. Number 1, these real options are not traded. And so the question for a decision maker is not what exactly is the value of this put option that we attach to the factory, but is it valuable enough to put the whole thing in the money, the whole prospect in the money, and far enough in the money that the manager will feel confident going ahead, even though everybody knows that things will go wrong and there'll be overruns and da-da-da-da-da. Right? So for a corporate financial manager, the decision is not exactly what the option is worth, but is it valuable enough to make the manager confident to go ahead and take the risk of something going wrong. And by the way, in this context, you don't need to know exactly what the real option is worth. They're not traded. If you have a traded option and you have decided that it's worth X and it's trading for Y, then you've got a profit opportunity. But with these things that are not traded, if you decide it's worth X and somebody else says it's worth Y, it says, I don't care. Can't do anything about it. The only question is, am I confident enough to go ahead? So that's the second reason. The third reason is lack of structure. Got that? Yeah. Oh, there, okay. Third is lack of structure. We think of real options and we think we understand what they are, but if you try to write down what they are, it's sometimes very hard. How do you write down the exercise price of that put? You don't know what you can abandon the factory for. How do you know what the right maturity is for the put? I guess it's very long, but you don't know for sure. And so if you look out into the future and you know a real option is there, you may not be able to identify it. Let me be careful. You can identify it, but can you write down its attributes with any confidence? Or do you just have a fuzzy idea of what the exercise price might be or what the optimal exercise policy might be or so on? Now the one exception, and here I'm glad Judy is here, I've always thought that pharmaceutical R&D is a perfect example of something with considerable structure. And the reason is that, at least for the standard view of drugs going through phase 1, phase 2, and phase 3, et cetera, they all have to go through the same steps. All candidate drugs have to pass these hurdles. And there's lots of historical data on the probabilities of success. Companies probably have a pretty good idea of what it's going to cost to do an investment to do the work at the various stages. And so it's a problem of analysis and valuation where focus gets better. Not perfect. And I grant that I'm only thinking about drugs going through a plain vanilla life cycle of testing. But that's a situation where I think that there's enough structure that valuation techniques have worked and have been very successful. Judy was well known at first at Merck for doing Monte Carlo simulation of drugs and trying to foresee the distribution of the portfolio of drugs that Merck might have after whatever it was, 5 years or 10 years. Okay? Now, by the way, Monte Carlo probably works for traditional pharmaceutical R&D for the following reason. If you have to start with, pick your number, 100 drugs, and you know that the failure rate is going to be very high, but nevertheless, each of the 100 drugs you start with has enough upside to make you interested in investing in it, then if the drug survives phase 1 or phase 2, the odds are it's way in the money. And if it's way in the money, the exercise price is easy, and you can do the Monte Carlo simulation. And I've worked on that quite a while ago now. On the other hand, growth opportunities don't have structure. So if you have a growth company, an Apple or a, God forbid, NVIDIA, how do I say that? These growth companies, we know they have valuable growth options. That's why they're selling at the market caps they are. On the other hand, if you asked the CFO of one of those companies, give me precisely the parameters of an investment opportunity 5 years out, they couldn't do it. Right? Because the technology changes. You don't know what the exercise price is going to be. Depends on an awful lot of things. It also depends, by the way, on what the competitors are doing. You don't know that either. So you could know for sure that you have a valuable growth opportunity, but not be able to write it down with enough precision to put a definite value on it. And that's the tendency in corporate finance, that real options are a way of understanding what's going on, and in some cases where the structure is there, actually calculating value. But in many cases, they help enormously in understanding what you're facing, but they're very, very difficult to value. Now, my second question is, what is the debt capacity of an option? Okay, now we got to be careful, because debt capacity is an unfortunate term of art. We tend to use it, but it sounds like it's the maximum amount you could borrow. That's not the way that I think about it, not the way I think most people think about it. They think about it instead as a target leverage. Okay? A prudent, usually prudent, target leverage. Now, if we have a real call option, a growth option, what is a prudent target leverage for that growth option? There's been a lot of thrashing around in the corporate finance literature that hasn't gotten anywhere until Jamie Reed and I finally, 30 years late, figured out the answer. And here is the answer. Suppose we want to value a call option. Well, go back to basic Black Scholes, and I'm going to stick with very simple examples here. You take delta times the NPV of the underlying, or I would say APV of the underlying. APV is a signal that we're worried about taxes and so on, minus the APV of the option leverage. So it's delta times APV minus what I'll call D sub C, option leverage. And that's what it would take to replicate the option at this snapshot of time. Okay? So let's suppose the company has a target debt ratio of lambda. What's the debt capacity of that call? It's lambda times delta times the underlying minus the option leverage. Here we were, as I say, thrashing around as a field and not being able to understand how call options and growth opportunities affected leverage or target leverage. And it's right here in the basic Black-Scholes-Merton formula. It's only a matter of realizing that the underlying, that if you have the option, you have a position in the underlying times delta. The underlying has the same attributes as your assets in place. So if you've decided that lambda is the right target for your assets in place, then you just multiply by lambda. But the debt, the option debt, should displace ordinary borrowing. In other words, think of it this way. Option leverage is something that growth firms have to worry about. If they've got valuable call options out there, they have option leverage. The option leverage takes the form of the exercise price they have to come up with if they want to actually exercise the option and cash in on the growth opportunity. So it's like having off-balance sheet debt. It's exactly like having off-balance sheet debt. And if that's the case, and you're a rational financial manager, and you have a lot of off-balance sheet debt, what do? You cut back on explicit debt. In other words, the off-balance sheet debt substitutes for explicit debt. And then what do you see when you're looking at the company? You're seeing you're seeing what appears to be a low debt ratio, but it's only a low debt ratio because you're only seeing the explicit debt and not the total debt. Okay? This thing's flashing at me. Does that mean something? Let me keep going. In the slides, you can look at a simple binomial example that Jamie Reed and I put together. And let's skip to the next one, where I just write down the net debt capacity of this particular call option, a one-period binomial call. And it turns out that the debt capacity is negative. Now, what's happening is that the APV part of it, delta times lambda times APV, is actually supporting debt for the next snapshot of time. But the option leverage is bigger, and the net is negative. So in the example, the option leverage is minus 14.72. Minus. Okay? So the call option is worth $13.33. And I'm skipping ahead because I'm worried about time. Minus 14.72. Now, if you skip to the next slide, you'll see what you would actually observe. Here we have a company that has assets in place of 100 or 101. It gets the APV of the call. That's good, $13.33. When you look at the other side of the balance sheet, they're going to see debt of 35 and equity of 78, which is a debt ratio of about 31%. Even though the target debt ratio for assets in place is 50%. Now, what's happening here is that the equity investors get the value of the call. But on the other hand, the option leverage associated with the call displaces regular debt. And so, in effect, the company has to pay down the regular debt to get back to its target. And the company will look like it's operating at 31%, even though if you take all of the debt together, they're still at their 50. That's what's going on. All right? Now, it does rely on the assumption that the managers are smart enough to recognize the leverage and to compensate for the option leverage by backing off on explicit debt if necessary. And that's what happens with growth companies. Now, that in a way answers the question I was working back on 1977, right? The answer is, why do growth companies borrow so little? The answer is they don't. It's just that a lot of their debt is off balance sheet. It's as simple as that. Okay, well, nobody's telling me to stop, so let me go on and is option leverage really off balance sheet debt? Well, one of the claims here is that, wait a minute, option leverage is not really debt because you can default on the option leverage and it's not an event of default. That's a narrow view of it, because option leverage is leverage. It does increase risk in the same way that ordinary debt does. It increases the risk of the equity. The option leverage is really equivalent to a collateralized non-recourse loan. The underlying is the collateral, and you can let the collateral go by not exercising. On the other hand, that's likely to be very costly. Well, it doesn't have to be costly. It depends on how valuable the underlying is. But if the option is well in the money, then defaulting on the option leverage is a very expensive thing. And it seems to me that with that observation, a prudent CFO would indeed back off on regular borrowing if the option leverage was important. Okay. I'm going to skip over the next 2 pages and get to the page to say, what can we say about the capital structure of a corporation by real options? So if option leverage is off balance sheet, then growth companies will appear to operate at very low debt ratios. Declining companies will appear to operate at high debt ratios because the properties of a real put option go the other way. And observed debt ratios will appear to violate our corporate finance people's nice theories about trade-offs and stable target debt ratios and all of that. If you actually do experiments or simulations of what you observe corporations' debt ratios as doing, what they are doing over time, it looks like they don't have a target debt ratio. For example, it's typical that if your corporation has valuable growth opportunities and gets a positive shock, that's good news. The bad news is that the option leverage has gone up and the explicit debt will go down. So you have an odd thing that the companies are more valuable, but it borrows less or appears to borrow less. Right? That doesn't always happen, but it's typical. Right? So if you go into a textbook and look at the so-called trade-off theory of capital structure and look at what the actual behavior is, it'll appear the actual behavior is disproving that textbook theory, even though the company is following it exactly when you add up both the off-balance sheet and the on-balance sheet debt. So I think you've got the idea. Let me skip over to the last page, page 20. This is the thing. This is the problem I was working on back in '77. To summarize, why do profitable growth companies borrow so little? The answer is they don't. It's just that a lot of their debt is off balance sheet. Because the debt is off the balance sheet, it looks like they're leaving a lot of money on the table, for example, with interest tax yields and so on. Now, there's several, I should say, theories that have been developed over time to explain why growth companies don't borrow very much. We have the trade-off theory that goes all the way back to Alex Robichek and me in 1966. We have the pecking order theory, which I pushed for a number of years, and I think still has some empirical punch. You have various agency theories. And this, however, is my current theory. And Occam's, if you just remember Occam's razor, it seems to me that this theory wins. Let me turn it over to Judy.
Thank you very much.
No slides. This is a one-man band, no slides. I do want to start by echoing how Stu started. I am honored to be part of this symposium celebrating 50 years and counting of Black, Scholes, Merton derivatives. As some of you know, my counting is more like 52 years because as a Sloan graduate of the class of 1972, I was an early beneficiary of the theories being perfected by Myron Scholes, Bob Merton, and Stu Myers. Now, although I can't pinpoint the reason or a moment in time, I have saved all of the course material I received for Merton's class 15.422 in mimeograph form. You want to talk about pieces of paper? I've got it in mimeograph form, as well as an original copy, which has now been autographed by Bob Merton, of his working paper entitled Theory of Rational Option Pricing from October 1971. I have to interject here too. I was reminiscing last night. I was at a convocation at Sloan many years in the late 80s, and the person presiding said, who in the class, who in the room graduated from 1973 and on? And they all raised their hand except me, right? And then they said before, and I raised my hand. They said, well, then you don't know anything about Black, Scholes, Merton. I said, no. Actually, I do. I was there at the beginning, and when I relayed the story to Bob, I remember he said, because we brought research into the classroom, which is what made the whole Sloan experience so very special. So in any event, I also must note that the first edition of Brealey and Myers, which I consider to be the Bible of corporate finance professionals, was not published until 1981. Therefore, my exposure to Stu's seminal work on corporate finance was in the classroom 9 years before. That said, and Stu already referenced this, he and I have had decades-long dialogue about capital structure, risk return and cost of capital, and capital budgeting in the pharma industry. Today's session, 46 years and counting, Real Options, based on one of Stu's and James's papers, Real Options and Hidden Leverage, is another milestone in this important discussion. I would like to share my experiences in pharma as they pertain to real options and hidden leverage. In the late 1980s, my Treasury team was asked to develop a capital structure policy for Merck. We determined that given the business risks of pharma, high failure rate of R&D programs, product liability, and intellectual property challenges, just to name a few, the company should not incur additional risk. For this purpose, in the form of financial leverage. With that policy in place, and for decades, Merck was a AAA-rated company, rarefied territory, we were challenged by academics, bankers, and board members about this stance, arguing that we weren't maximizing shareholder value, for example, by using more of the tax shield from debt, along with more aggressive share buybacks. These challenges, coupled with policymakers' views about the fairness of pharma rates of return using return on assets as a benchmark, stimulated additional critical thinking about our capital structure. One such area to consider was the accounting treatment of R&D expense, which was expensed, not capitalized, thereby understating the assets of the firm and the return on, and overstating the return on assets. Furthermore, if we capitalize R&D as an asset, what is the offsetting liability? Our proposed response then, and in discussions with Stu and his colleagues, was debt as a proxy for the long-term spending commitment or mortgage element requisite to fund the R&D. Both of these economic realities are not reflected in the accounting statements, leading to an understatement of assets and leverage and an overstatement of returns. This view, along with the recognition that R&D is a real option, which should incorporate these elements, brings us to Stu's elegant resolution of hidden leverage in pharma. Namely, the debt ratios of pharma and biotechs must incorporate the real options of R&D. I would like to note that this framework provides a useful approach to value a pharma company, the value of the assets in place, plus the terminal value growth rate, a majority of which is the value of growth options or real options. In this case, when a company's value consists in large part of growth options, the expected costs of financial distress from higher debt levels can lead to underinvestment, which Stu touched on earlier. There's a real cost to that, and will generally outweigh the tax benefits of debt. Therefore, maximizing capital structure is likely to consist largely, if not entirely, of equity. This observation is also relevant to the financing decisions of a biotech company, and you particularly have an isolated example as a pipeline product nears launch. And one of Stu's slides talk about the evolution of options, valuation, and debt capacity as the asset matures. Such, for example, as a product launch expenses. In those events, when a product has finally made it through the riskier part of R&D and is on the threshold of launching, and at this juncture you need perhaps hundreds of millions of dollars to launch a new product, that is exactly the point that increases the firm's capacity for explicit borrowing dollar for dollar, because now you're really close to realizing the value of that asset. Thus, the immediate source of financing for capital investments, in this case launch expenses, can be 100% debt. This is also notable because it is a departure from the source of capital earlier in the R&D life cycle, especially with single product, early stage biotechs, which again has to be predominantly equity. The finding of Stu's work on hidden leverage complement other capital structure insights from Stu's work, such as, he noted, trade-off theory, financial distress and debt overhang, financial flexibility, and pecking order theory. Now I'm coming close to the end, and before I close, I would like to offer one of the many examples of the impact which Black-Scholes Merton option pricing has had to enable the practice of finance to add value to the firm. Now, Jonathan touched on this a little the other day, but in this case, we're talking about options, not forwards, not swaps. The foreign exchange hedging program implemented at Merck during my tenure used options to effectively hedge an appropriate percentage of Merck's non-dollar cash flows, thereby reducing a key element of uncertainty in business planning by dampening the volatility of earnings and cash flow results over a 20-year period. That concludes my comments and discussion, and I turn it over to whoever's going to handle it.
So thank you very much, Stu, and thank you very much, Judy. We're going to try and stay on schedule, so we have about 5 minutes for any questions, Q&A, which I'll direct to Stu, and so you can probably answer from there with if you speak loudly or come up. So Paul.
I have a question which applies to startups. They ordinarily sequentially raise equity, but they almost always have to raise subsequent rounds with preferred equity, and that produces lots of conflicts. Can anyone comment about whether that is a sensible, common process, or whether it doesn't really make sense, but we've just fallen into it?
Yeah. So, Stu, do you want to comment on sort of the option to go to retap capital markets, or how that affects any of what you just talked through?
It doesn't affect much of what I said. I always thought that having the preferred, for example, in the later rounds, was because of the desire or demand of the new money that's coming in the later rounds, to have a leg up or a step ahead of the old money. The old money would love to have new money coming in on the same terms, and the new money would rather to have some privileged position. The preferred, as I recall, changes into equity if there's an event, like going public. But in the meantime, it gives them a preferred position. Now, as far as taking debt for a startup relying on debt, it raises the same problems that I was talking about. Seems to me.
Yeah. So raising preferred in some sense, because it's basically an equity, even though it looks at like debt, is consistent with the idea that you don't want a debt
equity
type.
if everything works out. So
Yeah.
that's what I always thought was going on. But I can't say anything more.
Myron? No, it's coming.
Thank you. Now, just wondering, Stu, if you have these, your real options, the theory you have, what is it the case, since they're private options within the firm, can they figure out ways to actually reduce the volatility or reduce the cost of the options over time? So there's a dynamics to your thinking and how it would evolve over time. For example, right now in production or building factories, they have this thing called a digital twin. So they figure out how to make the factory efficient as opposed to making it in solid and concrete. So I was wondering what your theory would say about how firms would evolve over time to actually reduce the cost of these options and therefore could substitute debt.
I think you touched on this yesterday. When you're thinking of that factory that might be 5 years out, it's the downside risk you're worried about. And you wouldn't want to hedge it in such a way that you give up the upside, because that's what your option value is based on. But if doing a digital twin cuts the risk that the factory will be a turkey, then that's a worthwhile thing to do. And anything you can do to truncate that kind of risk seems attractive, so it doesn't cost too much money.
Okay, so I think we're at our break time. We have a 15-minute break. When we come back, I came from Northwestern, and we brought in an expert from Northwestern who's been doing phenomenal work on options. Ian Dubecker will take over at 10:15 and talk to us about options. Until then, we have 15 minutes, so enjoy. Thank you very much, Stu and Judy.